Right now, millions of seniors are at risk of losing Medicare benefits they've counted on for years. The 2026 enrollment changes are unlike anything we've seen in recent memory. Most people won't realize what happened until it's too late. If you depend on Medicare for your health care, you need to hear every word of this video. I've spent over 3 decades helping people just like you protect their retirement benefits. What I've uncovered about the 2026 Medicare enrollment period genuinely alarmed me. There are traps buried in the fine print that could cost you thousands of dollars. And there's one hidden rule that almost nobody is talking about that could actually save your coverage. This isn't about scaring you into watching a long video. This is about making sure you don't wake up one morning to find your prescriptions aren't covered anymore. I'm going to walk you through every pitfall, every deadline, and every opportunity step by step. Grab a pen and a notepad because you're going to want to write some of this down. Let me start with the big picture of what's actually changing in 2026. The Centers for Medicare and Medicaid Services, known as CMS, has announced significant adjustments to Medicare for the coming year. These changes affect Part A, Part B, Part C, and Part D in ways that overlap and compound. Understanding each piece individually is the only way to see the full impact on your wallet. According to CMS.gov, the standard Part B premium for 2026 is projected to rise to around $185 per month. That's up from $174.70 in 2025, which means an increase of roughly $10.30 every single month. Over a full year, that adds up to an extra $123.60 coming out of your Social Security check. For many of you, that wipes out a good chunk of your cost of living adjustment. Now, the Part B deductible is also going up in 2026 to an estimated $257 per year. In 2025, it was $240. So that's another $17 you're paying before Medicare even kicks in. These numbers might seem small in isolation, but they add up fast when combined with other changes. Think of it like a slow leak in a tire. You don't notice until you're stuck on the side of the road. The Part A hospital deductible is climbing as well, projected to hit approximately $1,676 per inpatient stay in 2026. That's the amount you pay before Part A starts covering your hospital costs for each benefit period. In 2025, it was $1,632, so you're looking at an additional $44 per hospital admission. If you have 2 hospital stays in a year, that's nearly $3,400 out of pocket, just for deductibles. Medicare Advantage plans under Part C are also seeing major shifts in 2026. CMS has tightened the star rating system, which directly affects how much funding insurance companies receive for these plans. When funding gets cut, insurers often respond by reducing benefits, shrinking provider networks, or raising out-of-pocket costs. This is happening right now for 2026, and your plan might look very different from what you had last year. Let's dig into the first major area where seniors are losing benefits without even realizing it. I call this the silent disenrollment trap, and it catches thousands of people every single year. It happens when your Medicare Advantage plan withdraws from your county or makes changes that effectively remove coverage you rely on. You might receive a letter in the mail that looks routine, but buried inside is a notice that changes everything. Here's how this plays out in real dollars and real consequences for your health care. Let's say you're enrolled in a Medicare Advantage plan that covers your diabetes medications at a $15 copay. For 2026, that same plan decides to move your medication to a higher formulary tier with a $75 copay. That single change costs you an extra $60 per month, or $720 per year for just one medication. But it doesn't stop there because many plans are also changing their preferred pharmacy networks. If your local pharmacy drops out of your plan's preferred network, your copays could double or even triple overnight. A prescription that cost you $10 at your preferred pharmacy could suddenly cost you $35 at a non-preferred one. Over 12 months, that seemingly small change adds up to an extra $300 you weren't expecting to pay. The most dangerous part of this trap is the timing of when you find out about these changes. Plans are required to send you an annual notice of change, often called an ANOC, by September 30th each year. Most people glance at it and toss it in a drawer without reading the details carefully. By the time they realize their benefits have been cut, the enrollment window may have already closed. Let me give you a real-world example that I've seen play out dozens of times over my career. A woman I'll call Margaret was on a Medicare Advantage plan that included dental, vision, and hearing coverage. In 2025, her plan sent an ANOC stating that dental benefits were being reduced to preventive care only. Margaret didn't read the notice and found out in February when her dentist said her crown wasn't covered anymore. The cost of that dental crown was $1,200, which Margaret had to pay entirely out of her own pocket. Under her old benefits, she would have paid only a $350 copay for that same procedure. That's $850 she lost because she didn't read a single piece of mail carefully enough. This kind of thing is happening to thousands of seniors heading into 2026, and I don't want it to happen to you. Now let's talk about the Part D prescription drug changes, which are genuinely significant for 2026. Thanks to the Inflation Reduction Act, there is now a $2,000 annual out-of-pocket cap on prescription drug costs under Part D. This cap took effect in 2025 and continues into 2026, which is fantastic news for seniors with high medication costs. However, the way this cap interacts with your specific plan's formulary can create unexpected gaps in coverage. Here's what I mean by unexpected gaps in your prescription drug coverage. Your plan might technically have the $2,000 cap in place, but it could remove certain brand-name drugs from its formulary entirely. If your medication isn't on the formulary, the $2,000 cap doesn't help you because the plan won't cover it at all. You'd be paying the full retail price, which for some specialty drugs can run $500 to $1,000 per month. According to CMS.gov, plans can change their formularies each year as long as they notify enrolled members in advance. But in advance often means a letter sent in October that you might not fully understand until January. By then, you're locked into your plan for the year unless you qualify for a special enrollment period. This is why reviewing your plan's formulary before enrollment closes is absolutely critical for 2026. The annual enrollment period for Medicare runs from October 15th through December 7th every year. That gives you just 54 days to review your options, compare plans, and make changes that affect your entire year. If you miss that window, you could be stuck with a plan that doesn't cover your medications or your doctors. 54 days sounds like a lot, but when you factor in holidays and the complexity of these decisions, it flies by. Let me also address something that trips up a lot of seniors: the difference between the annual enrollment period and the open enrollment period. The Medicare Advantage open enrollment period runs from January 1st through March 31st each year. During that window, you can switch from one Medicare Advantage plan to another, or drop your Advantage plan and go back to original Medicare. But you cannot use this period to join a Medicare Advantage plan if you're currently on original Medicare. Stay with me, because what I am about to show you will surprise you about how these enrollment periods interact. Most seniors think they have until March to fix any enrollment mistakes, but that's only partially true. If you switch plans during the open enrollment period, your new coverage doesn't start until the first of the following month. That means you could have a gap in coverage for certain benefits that leaves you financially exposed. Let me walk you through the second major insight that catches seniors off guard heading into 2026. This one involves the Income-Related Monthly Adjustment Amount, known as IRMA, and it's a hidden surcharge on your Medicare premiums. If your modified adjusted gross income exceeds certain thresholds, you pay significantly more for both Part B and Part D. And here's the kicker. IRMA is based on your tax return from 2 years ago. For 2026, the IRMA thresholds are based on your 2024 tax return. If you sold a property, cashed out an IRA, or had any unusual income event in 2024, it could trigger higher premiums now. The first IRMA tier kicks in for individuals with income above approximately $106,000, or couples above $212,000. At that level, your Part B premium jumps from $185 to roughly $259 per month, an extra $74 monthly. But the IRMA brackets get much more severe as your income climbs higher than that first threshold. At the highest bracket, for individuals earning above approximately $500,000, the Part B premium soars to around $578 per month. That's nearly $400 more per month than the standard premium, adding up to an extra $4,700 per year. Most people who get hit with IRMA don't see it coming until they receive that shocking letter from Social Security. Here's a scenario I see all the time that catches retirees completely by surprise with IRMA. Let's say you retired in 2024 and rolled over a 401k into an IRA, triggering $150,000 in reportable income. Even though you didn't actually spend that money, the IRS sees it as income on your 2024 tax return. Fast forward to 2026, and Social Security is now charging you an extra $148 per month in IRMA surcharges. That's an extra $1,776 per year in Medicare premiums because of a one-time financial transaction you made 2 years ago. Many retirees don't realize that rollovers, Roth conversions, and capital gains all count toward the IRMA calculation. This is money being taken directly from your Social Security check before you ever see it hit your bank account. It's essentially a hidden tax on your retirement income that reduces your monthly benefit substantially. Now, there is a way to fight back against IRMA if you qualify for what's called a life-changing event appeal. If your income dropped in 2025 or 2026 due to retirement, divorce, death of a spouse, or other qualifying events, you can file SSA Form 44. This form asks Social Security to use your more recent, lower income instead of the 2024 tax return. If approved, your premiums could drop back down to the standard rate, saving you hundreds or even thousands per year. The key is filing that SSA Form 44 as soon as possible, because IRMA surcharges start immediately in January 2026. Every month you delay is another month of overpaying your Medicare premiums unnecessarily. You can file this form at your local Social Security office or by calling Social Security at 1-800-772-1213. Make sure you bring documentation of your life-changing event, such as a retirement letter or a divorce decree. Let me give you another real-world example of how IRMA catches people off guard financially. A retired teacher I'll call Richard sold his rental property in 2024 for a $200,000 capital gain on top of his pension income. His total income for 2024 exceeded $212,000, pushing him into the second IRMA tier for married couples filing jointly. His Part B premium for 2026 jumped to approximately $370 per month instead of the standard $185. Richard's wife was also on Medicare, so both of their premiums were hit by IRMA simultaneously. Combined, they were paying an extra $370 per month just in Part B surcharges above the standard premium. That's $4,440 per year in extra Medicare costs they hadn't budgeted for in their retirement plan. If Richard had planned the property sale differently or spread it across 2 tax years, he might have avoided this entirely. The lesson from Richard's story is that retirement income planning and Medicare planning are deeply connected. Every financial decision you make, from Roth conversions to Social Security claiming strategies, affects your Medicare premiums. Too many seniors plan these in isolation, without understanding how one decision ripples through everything else. A good retirement plan considers taxes, Social Security, and Medicare costs as one interconnected puzzle. Now here is the part most seniors never hear about when it comes to protecting Medicare benefits in 2026. There's a critical enrollment mistake that can actually cause you to lose your Medigap supplemental insurance coverage permanently. If you currently have a Medigap policy and you switch to a Medicare Advantage plan during open enrollment, you might not be able to get your Medigap policy back. This is one of the most devastating and irreversible mistakes a senior can make. Let me explain why this Medigap trap is so dangerous and how it works against you over time. When you first enroll in Medicare Part B, you get a 6-month Medigap open enrollment period with guaranteed issue rights. During that window, insurance companies cannot deny you coverage or charge you more because of pre-existing conditions. But once that window closes, you lose those guaranteed issue rights in most states permanently. So here's what happens when you leave your Medigap plan to try a Medicare Advantage plan for a year. You drop your Medigap Plan G, which was costing you $180 per month, to join an Advantage plan with $0 premiums. 6 months into the Advantage plan, you realize your doctors aren't in the network and your costs are higher. Now you want to go back to Medigap, but the insurance company can deny you or charge you $400 per month due to health conditions. This scenario plays out for thousands of seniors every single year, and the financial damage is enormous. The difference between $180 per month and $400 per month for the same Medigap plan is $220 per month extra. Over 10 years, that's $26,400 in additional premiums just because you made one enrollment switch that didn't work out. Some seniors with serious health conditions can't get Medigap coverage at any price once they've given it up. There is one important exception to this Medigap trap that you absolutely need to know about right now. If you join a Medicare Advantage plan for the first time and you disenroll within 12 months, you have a trial right. This trial right gives you guaranteed issue back into your old Medigap plan or a comparable one without medical underwriting. But this trial right only works if it's your first time trying Medicare Advantage. You don't get a second chance. According to CMS.gov, this trial right also applies if your Medicare Advantage plan leaves your service area or stops offering coverage. In those situations, you have guaranteed issue rights to purchase Medigap plans A, B, C, F, G, K, or L. The window for using these guaranteed issue rights is typically 63 days from when your coverage ends. Missing that 63-day window means losing your guaranteed issue rights, so mark your calendar carefully. Let me walk you through how to evaluate whether your current Medicare plan is still the right fit for 2026. Start by pulling out your current plan's evidence of coverage document and your annual notice of change. Compare your 2025 benefits side by side with what's being offered for 2026 in every category. Pay special attention to prescription drug coverage, specialist copays, and maximum out-of-pocket limits. Next, make a complete list of every medication you take, including the dosage and how often you fill each prescription. Go to Medicare.gov and use the Plan Finder tool to enter your medications and see which 2026 plans cover them. The Plan Finder will show you estimated annual costs for each plan available in your zip code. This comparison can reveal differences of $1,000 or more per year between plans that look similar on the surface. Don't forget to check whether your doctors and hospitals are still in your plan's network for 2026. Provider networks change every year, and a doctor who was in-network in 2025 might not be in 2026. If your primary care physician or a specialist you rely on drops out of your network, your costs for seeing them could increase dramatically. An in-network specialist visit that costs you $40 could cost $150 or more if that specialist is now out of network. Also pay attention to the plan's star rating, which CMS publishes every year based on quality and customer satisfaction measures. Plans with higher star ratings generally offer better benefits and may qualify for bonus funding from Medicare. If your plan's star rating dropped from 4 stars to 3 stars for 2026, that's a red flag about declining quality. CMS publishes these ratings at Medicare.gov, and I encourage you to check your plan's rating before enrollment closes. Now let me address the specific situation facing seniors who are turning 65 in 2026 and enrolling in Medicare for the first time. Your initial enrollment period is a 7-month window centered around the month you turn 65. It starts 3 months before your birthday month, includes your birthday month, and extends 3 months after. Missing this window can result in permanent late enrollment penalties that increase your premiums for life. The Part B late enrollment penalty is an extra 10% added to your premium for every 12-month period you were eligible but didn't enroll. If you waited 2 years past your initial enrollment period without qualifying employer coverage, your penalty would be 20%. That penalty is added to your monthly Part B premium for as long as you have Medicare. It never goes away. On a $185 monthly premium, a 20% penalty adds $37 per month, or $444 per year, permanently. The Part D late enrollment penalty works similarly, but is calculated differently based on the national average premium. For every month you went without creditable prescription drug coverage, the penalty is 1% of the national base beneficiary premium. In 2026, the national base beneficiary premium is estimated at approximately 36.78 cents per month. If you went 24 months without coverage, your penalty would be roughly $8.83 per month added to your Part D premium forever. Now here's the hidden gem that most seniors and even many financial advisors don't know about regarding Medicare enrollment. If you're still working and covered by an employer group health plan at age 65 or older, you may not need to enroll in Part B right away. When you eventually retire or lose that employer coverage, you get a special enrollment period of 8 months to sign up for Part B without penalty. This can save you thousands of dollars in premiums during the years you're still working with employer coverage. But here's the crucial detail that makes this hidden gem actually work in your favor properly. The employer plan must be based on current employment, not COBRA, not retiree health benefits, and not marketplace coverage. If you rely on COBRA or retiree benefits instead of active employer coverage, those don't qualify for the special enrollment period. Enrolling late under those circumstances would trigger the permanent penalties I just described, costing you hundreds per year forever. There's another hidden benefit that many seniors don't claim, and it involves the Medicare savings programs run by your state. These programs can pay for your Part B premiums, deductibles, co-pays, and co-insurance if your income and assets fall below certain thresholds. The Qualified Medicare Beneficiary Program, or QMB, covers all Medicare cost sharing for individuals with income below roughly $1,275 per month. That's potential savings of over $2,200 per year in Part B premiums alone, not counting deductible and copay savings. Even if your income is slightly above the QMB threshold, you might qualify for the Specified Low-Income Medicare Beneficiary Program called SLEM. SLEM covers your Part B premium if your monthly income is below approximately $1,526 for an individual in 2026. There's also the Qualifying Individual Program, or QI, for those with income up to around $1,715 per month. Many eligible seniors never apply because they don't know these programs exist, or they assume they won't qualify. To find out if you qualify for a Medicare savings program, contact your State Health Insurance Assistance Program, known as SHIP. SHIP counselors provide free, unbiased help with Medicare questions and can walk you through the application process step by step. You can find your local SHIP office by visiting shiphelp.org or calling 1-877-839-2675. These counselors are trained volunteers and certified professionals who have no financial incentive to steer you toward any particular plan. Another hidden benefit involves the Extra Help program, also called the Low-Income Subsidy, for Part D prescription drug costs. If you qualify for Extra Help, you could pay as little as $4.50 for generic drugs and $11.20 for brand-name medications in 2026. The income limit for full Extra Help is approximately $22,590 per year for an individual, or $30,660 for a married couple. You can apply directly at ssa.gov or by calling Social Security at 1-800-772-1213, and the application takes about 20 minutes. Now let me give you the specific action steps you need to take right now to protect your Medicare benefits for 2026. First, find your annual Notice of Change letter and read every page carefully, especially the sections about formulary changes and network updates. If you can't find your ANOC, call your plan directly and request a copy or view it at Medicare. This single document tells you exactly what's changing about your coverage for the coming year. Second, go to Medicare.gov and use the Plan Finder tool to compare all available plans in your area for 2026. Enter your medications, your preferred pharmacies, and your doctors to get personalized cost estimates for each plan. Write down the top 3 plans that cover your needs at the lowest estimated annual cost. The deadline for making changes during the annual enrollment period is December 7th, so don't wait until the last minute. Third, if you believe your IRMA surcharge is incorrect because of a life-changing event, file SSA Form 44 immediately, call Social Security at 1-800-772-1213 to schedule an appointment, or visit your local office with your documentation ready. Also check whether you qualify for a Medicare savings program or Extra Help by contacting your local SHIP office at shiphelp.org. Every dollar you save on premiums and copays is a dollar that stays in your retirement budget where it belongs. Let me wrap up by reminding you of the single most important takeaway from everything we've covered today. The biggest risk to your Medicare benefits in 2026 isn't the premium increases or the policy changes. It's not reviewing your coverage. 15 minutes with the Medicare Plan Finder tool could save you $1,000 or more next year in unnecessary costs. The seniors who protect their benefits are the ones who take action before the December 7th deadline passes them by. If this video helped you understand your Medicare options better, I'd appreciate it if you'd hit that subscribe button below. I put out new videos every week focused on helping you keep more of the money you've earned in retirement. Next time, I'm covering a little-known Social Security strategy that could increase your monthly check by up to $400. You won't want to miss it. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with ssa.gov or medicare.gov.